Hey everyone, it's Marco from the DeGroot Finance and Investment Council, and today we're going to go through a leveraged buyout lesson. Specifically, we're going to be looking at a paper LBO model example. So if you're unfamiliar with what an LBO is, you should probably go and search that up first. But essentially, an LBO is a leveraged buyout, and it's when a company purchases a company, mainly using debt to finance the transaction. So leverage buyouts, they're usually done by private equity firms who are known as financial sponsors. And this transaction really rose in prominence in the 1980s. Essentially, the company who's performing the LBO or takeover really wants to use a large portion of debt to finance this transaction. So that's why it's called leveraged. And the expectation with using a lot of debt in the LBO is that the return generated on the acquisition will be more than the interest paid on the debt. So it's a good way for them to get high returns while only having a small amount of capital, which would be their equity in the business. So usually the companies that have an LBO or are bought out are stable companies with strong cash flows. They have low debt usually. They're non-cyclical. They have good existing management teams. They have a large asset base that could be used as collateral, and these are just some good examples. So this lesson is courtesy of Street of Walls. So they have a full post about it if you want to check it out. Overall, this is great for anybody who wants to pursue a career in corporate finance, whether that be on the sell side or buy side. It's also good to know just for corporate development and consulting as well. If you're doing an interview, you're most likely going to have case studies, so you should be able to complete this without the use of a computer. So I'm going to be using Excel, but I'm going to show you some mental math hacks as a way to be able to perform this and not get nervous when you're trying to do it without Excel. So I really recommend put away your calculator and try to do this on your own. And if you're in first or second year, I really expect you to be able to do this, mainly because I'm making a video. So it should show how important this is to know. So there's just really 5 easy steps to doing this. It's kind of like a BuzzFeed 3-step or 3-ingredient mix. So essentially what we have here is you're going to be calculating the purchase price. We're going to be calculating our sources and uses, which is going to be debt and equity funds to be used towards the purchase price. We're going to build our income statement. We're going to calculate our levered free cash flow, and then we're going to do our ending purchase price, exit value, and returns. So these are our given LBO parameters and assumptions. When you're doing this in a case interview, you're not going to have a piece of paper with all of this information laid out. They're just going to say it to you, but I'm sure you don't want to hear my voice anymore, so you can just pause the video and you can just take a look and note what you think is important from this page, write it down, star it, and then we'll move on. Okay, great. So now that you've had some time to do that, this is essentially our tombstone for the day. This deal is acquiring DSB Cafe in the amount of $200 million in a leverage buyout. So I'm going to switch over to Excel and we're going to get started. So we have our DSB Cafe leverage buyout by the DeGroot Finance and Investment Council Financial Sponsor Group. So we're the acquirer and our target is DSB Cafe. We're going to acquire them at a purchase price of 5 times forward 12 months EBITDA. We're going to be using a debt to equity ratio of 1.5 times or 60-40. So you can see here we're trying to use less equity. We're only using 40%. This way we're going to end up amplifying our returns, and we're really hoping that this is going to be more than the interest rate on debt that we're paying, which is 10%. So here's some facts about the company that we're acquiring or doing a leverage buyout on. This is DSB Cafe. I'm sure most of us have been there before. They have great revenue of $100 million a year, and this is going to increase 10%. Their EBITDA is 40% of revenue, so it's going to be flat. It's going to stay the same. Capital expenditures are going to be 15% of sales. Our operating working capital is going to increase 5 million year over year. Our depreciation is 20 mil each year, and our tax rate is 40%. So let's learn a little bit about what we're trying to do. We're going to leave this exit or we're going to exit this investment in year 5. We're going to leave it also at a 5 times forward 12 months EBITDA, and we're going to pay all of our debt down in year 5 for simplicity's sake. So this is just a really clean way of organizing everything. Obviously, if you're on pencil and paper, you're not going to make it look like this, but if somebody was telling you what to do and you had Excel in front of you, you could try and make it look like this. Okay, so let's take a look. This is going to be step number 1. It's going to be pretty straightforward. Is we need to find our EBITDA in year 1. So I'm going to be flipping back and forth, so I'm pretty sorry about that. But we have revenue of 100, we have EBITDA 40% of revenue. So the first thing, all we have to do is 0.4 times 100. All of us should know that this would equal 40. Now we're going to have to take our multiple and multiply this by our EBITDA. So we're entering this investment, so we're purchasing it at a 5 times EBITDA multiple. So all we have to do here is 5 times 40, and this is going to give us $200. So step number 1, super straightforward. Purchase price is $200. Or 200 million, depending on how we want to look at this. I'll probably refer to it as $200 for simplicity's sake. So let's look at step number 2. We have to calculate the debt and equity funding amounts used for the purchase. So in the case, we said that we're going to do a 1.5 debt to equity ratio, which translates to 60% debt, 40% equity. So all we have to do here is do our 200 purchase price multiplied by 60%. Everybody should know that this equals 120. Then we look at our equity amounts. We're going to do 200 times 0.4, and this is going to equal 80. Obviously, you could have just done 200 less 120. It also would have given you 80, but that's besides the point. So our entry assumptions are we have the multiple of 5 times. Our EBITDA in year 1 is 40, so we're going to pay $200. This gives us our debt and equity percentage, and as you can see, it equals up, and we're going to be paying $200 for this company. So let's move on to step number 3, which is building the income statement. So I don't want you guys to be fearful of this. I'm going to end up whiting these parts out so you can't see, and then we're going to end up just working through it together. So if you're thinking in this question, it's a really simple income statement that we're setting up, and we're not really making full projections. We're just trying to get to our earnings before interest, which is our EBIT, and then obviously we're trying to get to our tax-affected earnings before taxes. So this isn't a full income statement. For the purposes of the case, it's simplified. So let's start off with line number 1, which is our revenue. So in the introduction, we knew our revenue was going to increase, start at 100 and increase 10% year over year. So sales revenue, it's pretty easy to fill out, and I'm going to have to change my font to black. So our sales revenue is 100, and we could truly just go through and fill this in. So if you do 100 times 1.1, well, you know 10% of 100 is 10, so you just add it together. That's going to equal 110. Then we look at 110. Okay, so it's another 1.1% increase from this. So all you have to do here is like a really simple way is if you end up just, what's it called? I have my little mental math helps over here since we're not using calculators and we're also going to be rounding. So if you look here, we're obviously taking 10%. So we're multiplying 1 times 110. It just gives us 110. Then we're multiplying essentially 0.1 times this, which gives us 11. So it's 121. So that's just like the simple mental math way to do that. So I'm just going to fill in these now because I can assume that you guys will be able to do that. Now let's look at our EBITDA. So we're taking 40% out of everything here. So we obviously know that 40% of 100 is just going to end up equaling 40. And if we look at 40% of 110, the simplest way to do this would just be like effectively 4 times 11, which is going to give us 44, right? So if you apply that methodology, obviously that's going to work out. And did I detail that over here? Yeah, I detailed that over here. So again, for 121, you take the same idea. We do 12 times 4, right? So everybody should know that 12 times 4, 48. And there we go. And let me just fill in the rest. So those are the first 2 lines. Now let's look at depreciation and amortization. So $20 every year. So that's going to be extremely simple. All we have to do is fill in $20 year over year. Now we just need to do our EBITDA less D&A. So 40 less 20, 20, and then we're going to get to 24, then 28, and so on. So I'll just fill those in. Now we have to calculate our interest expense. So this may trip you up at first, but it's pretty simple. We have $120 or $1 million in debt, and we are paying 10% interest on this debt. So effectively, we're not paying down this debt until year 5. That was assumed, or at the end of year 5, which translates to year 6. So that was assumed in the question. So all we have to do is take 10% of 120, which is just 12 year over year. So we can fill in all of the interest expense as well. Now we just have to less that to find our earnings before taxes. So obviously we have 8, and then we could go on so on. So I'll just fill that in. And then now we have to calculate our taxes. So we have our EBT and our tax rate, which was given to us, which was 40%, right? So all we have to do here is effectively know, okay, well, I know that 8 times 4 is like 32, but we're rounding, right? Because we're not supposed to be using a calculator here. So I'm going to call this 3, right? And then so on, right? If I know that 4 times 12, right, that's 48, we're going to round. We're just going to call this 5. And then I would do that for the rest. So those are just my mental math hacks. If they don't help you, don't use it, obviously. If it does help you, because I know like that was something that I found difficult because I just really never did mental math in my life. Always use the good old Casio FX991 or Excel. So just make sure you're practicing mental math. So regardless, let's take a look. All we have to do is simple subtraction here. So we would have 5, of course, then we would have 7, and so on. So that is our income statement completely filled out. So now I have a little note here, which I will show because some people may be confused. So essentially, we're looking here at our EBITDA multiple, which we're basing off a forward of year 5. So as you can see, we're calculating 6 years worth of information. So obviously that's why we're calculating 6. It's because we're using a forward EBITDA multiple based off of year 5. So it's year 5 plus 1 equals year 6. Our EBITDA multiple at exit means that it would be 64, not 59. So that's why we need to calculate this 6th year. But we do not need to calculate the 6th year for a free cash flow. We are only calculating year 6, so we could find this year 6 EBITDA that we would do our exit multiple on. And again, I just made a note about rounding here. You're doing it in your head, so don't worry. And then if we look here, again, let's just do a little review of the income statement. We took our revenue, And then we found our EBITDA just by multiplying by the percentage, subtracted D&A, which was held constant, to find our EBIT. After finding our EBIT, we less interest expense, which was held constant on $120 million of debt at 10%. We then found our earnings before taxes just by simple subtraction. After doing that, we multiplied by our 40% tax rate to find our taxes, and again, just less to that. And that gave us our earnings before taxes that is now tax affected. So let's move on to our next step, which is the free cash flow calculation. So again, I will delete that and we will move on. So the first thing's actually super easy to fill out here, but let's go through the formula for free cash flow. Free cash flow is essentially our EBIT multiplied by 1 minus the tax rate, plus depreciation and amortization, minus CapEx, minus changes to net working capital. This is just the super basic levered free cash flow formula that we're going to be using for this, okay? So now we can see our first line is our EBT tax affected. So we already calculated that, which is amazing. So all we have to do here is fill this in, right? It's just the exact things that we calculated up here. So there is no work that has to be done. And as you can see, I'm not filling in year 6 at all, because we know that we don't need this for a free cash flow. We only needed year 6 to find this 64 EBITDA. So let's look at depreciation and amortization. What's it say? It's $20 each year, right? So $20, and it's just going to be held constant. So you can just write that in. Our capital expenditures is going to be 15% of our sales. So in year 1, we had 100 sales. All we have to do is multiply that by 0.15. So that's pretty straightforward. It's just going to equal 15, right? Then we have to look at year 2, right? So we're going to do our 15% of 110. So essentially how I would look at this is if you just do 15 times 11, right? So if you do 15 times 11, that's like 165. And then we are rounding here. So since it's 0.5, you might as well round it to 17, which is what I did before. And then you just do that for the final year. So again, I would do 15% multiplied by 121, 15% of 133, and so on. So I'll just fill that in. Now we have to look at our change in net working capital. And this is very simple for us because they tell us that our operating working capital is increasing every year by 5. So all we have to do is just fill in 5 year over year. And then if I just highlight this, we'll see what we're adding and we'll see what we're subtracting here. So year 1, free cash flow, we have 5. Year 2, free cash flow, we have 6. Year 3, we have 7. And then it's just addition from here on out. So it's nothing too crazy. So this is effectively how we're finding our free cash flow. And then this should actually be 5, I believe. Yeah. Okay, so let's move on. So this is free cash flow. All we did is we took our EBIT from above, which was great, very simple. Our depreciation and amortization given in the case held constant. That's unreal, very simple. Our CapEx, we just took 15% of our sales. Our change in net working capital, again, it was given to us. It was simply just 5 year over year. So that was great. Then we just had to add and subtract, and we ended up getting our free cash flow. So now we have a few final steps, and we're going to wrap this up. So the first thing we have to do is calculate our ending purchase price. So it's the exit value, and this is going to give us our returns as well. So step number 1 is we need to find our total enterprise value at exit. Essentially, all we're doing here is taking our forward EBITDA at exit and then multiplying it by the exit multiple. So I believe our EBITDA was 64, and then we had that 5 times multiple. So we're just doing our 64 times 5, and this is going to end up giving us a 320 total enterprise value at exit, okay? So the next thing we need to do is find our ending debt, okay? So we had beginning debt of 120, and now you may be wondering, what is this debt pay down, right? Like that kind of just came out of nowhere. Well, we're using our free cash flow to pay down the debt effectively from this transaction. So this free cash flow, it's not going back into the company to fund acquisitions or do anything else. We're just using this debt, this free cash flow, to pay down the debt that we put onto the DSB Cafe because we did a leveraged buyout for them and we want to return. So all we have to do here is find our cumulative free cash flow. So if we do our 5 plus our 5 plus our 7 plus 8 plus 9, this should give us 34 for our cumulative free cash flow. And then we just do our beginning debt of 120, and then we less this cumulative free cash flow, which is going to be our debt pay down. So if we do our 120 less 34, we're going to end up getting a ending debt amount of 86. So essentially, how are we going to pay for this debt? Well, it's with the money that we're getting from the total enterprise value at exit. So what we have to do is take our find our ending equity value, right, which we're going to be using to calculate our return, and we're going to end up subtracting debt from our total enterprise value to do so. So we had this initial 320, and we're going to end up subtracting 86. So if we have this 320 and we less 86, it's going to equal like 234. And this is going to be our equity value at exit. Now we have to remember, so what was our beginning equity value? Well, our beginning equity value was 80, right? So we're going to end up calculating a multiple called a money of money multiple to end up finding our return. So what we're doing is we're taking our ending equity value divided by our beginning equity value. So I laid it out here in the simple long division way. So again, you're not supposed to be doing this with a calculator. So I just use this to help anybody out who forgot how to do long division because it's been some years, right? So if we do our 234 divided by 80, we end up getting 2.9. So think about it. If we ended up paying for the company all using our own equity at the beginning, and we exited and we had this ending equity value of 234, we wouldn't have returned or gotten, honestly, like a great return there. So our money on money multiple in that sense would only be like around 1 point something, right? As we can see, by reducing the amount of equity that we used, we ended up increasing the multiple of money, which is effectively going to give us a better return on the equity that we invested. So again, leverage just amplifies the results, good or bad. In our case, we ended up selling the company for more than we paid and more than the equity we ended up putting into it, and we were still able to pay down our debt. So that's great. So Now let's look at IRR. So we're going to estimate it based off this multiple of money multiple here. So you can just memorize this table for interviews. That's honestly probably the best way to do it. Another way of thinking about this is, it's kind of complicated, but I'm going to say it anyways, is if you double your money in 2 years, you're going to end up getting a 100% return. So if you have a doubling money scenario, so let's say you double your money in 3 years. You take 100% and you divide it by 3. This is going to give you around 33-ish percent, like point something. And then we have to think, okay, just with the IRR calculation and that, it doesn't work out to exactly being that. It's around like 75 to 80% of that simple division aspect there. So if you take 75% of that, it would give us a 25% IRR. So that's an alternative way to finding things. Or you could memorize this table, which is what I did, and it worked out quite well. So we had a 2.9 multiple. So that's around 3 times money on money multiple over our 5-year period, which is going to give us a 25% IRR, which is unreal. That's really good. So we can assume that the implied IRR for the paper LBO case study is around like 25% or approximately below, which answers our original question to see what the IRR was. So overall, this wasn't extremely complicated. We really just had 5 steps there. So I'll break it down again. First thing that we did is we ended up finding our purchase price, right? We found our EBITDA, and then we multiplied that by the forward EBITDA, and it gave us a $200 million or $200 purchase price. The next thing we did is we found our sources and uses, which is our debt and equity, and we just simple multiplication there. Step number 3 is we did a really reduced income statement, only going to tax affected EBT effectively, and that was it. We also had to calculate 6 years there because we needed to find our exit multiple at a forward 12-month EBITDA. The next thing we did is we calculated our free cash flow, and all we did there was our EBT tax affected plus depreciation and amortization, less CapEx, less changes to net working capital, and that gave us our free cash flow. We summed that free cash flow, and we were able to find how much we would use to pay down debt. So before we did that, though, we ended up finding our exit amount, which was our exit EBITDA multiplied by the 5 times exit multiple. That gave us the amount that we're exiting the investment at. We lessed the amount of debt. So we were able to find our ending debt, and we were able to find our equity value as well. With the equity value, we calculated our money on multiple of money or money on money multiple, and that allowed us to estimate our IRR. Okay, so hopefully this video was helpful. You should probably redo this case study without me talking. Do it all over again. Try to get the same answers. And I promise you, if you memorize this and keep on redoing it, it's really going to help you in the long run. So thanks for tuning in, and we'll see you at the next lesson.